Hello. Welcome to Insureblocks, your dedicated podcast to blockchain and smart contracts in the insurance industry. I'm Walid Al-Saqqaf, your host. For this week's podcast, we will be discussing how to unlock investment in blockchain projects. And I'm very pleased to have Areiel Wolanow, Managing Director of Insureblocks. Areiel, thank you for joining us today. Could you please give our listeners a quick introduction on yourself and on Insureblocks?
Hi, Walid. It's good to talk to you. So my name is Areiel Wolanow, and I run a small independent consultancy called Insureblocks. We advise, design, and deliver DLT solutions for financial services firms around the globe. We've worked with such clients as Lloyd's of London, HSBC. We're an advisor to the UK Parliament and to several central banks and financial regulators around the world.
Excellent. So, as you know very well, our first question here at Insureblocks is, could you please explain to our listeners what is blockchain and how does it work?
Blockchain is an enabling technology. It allows multiple separate legal parties to share a single version of data and keep that data in sync between themselves, removing the need to reconcile, message, propagate, sync, or otherwise try and keep versions of data that are owned by different parties reflecting one another accurately.
Great. That was very succinct. Thank you very much for that. So how did you get to blockchain? What has been your journey that has brought you to this technology, and where did it all begin?
So in early 2014, I was running IBM's financial services practice for East Africa, based down in Nairobi. The main project I was doing at the time was using machine learning to create credit scoring for M-Pesa. So that we could grant credit to people who didn't have any bank account or financial history. But I got an opportunity while I was there to solution a deal for the Ethiopian Commodity Exchange. Now, Ethiopia has a commodity exchange, which is a financial market, and 90% of the volume of that market is, of course, coffee. And they had a problem. And that problem was that the Fair Trade Association was threatening to revoke accreditation across the country because of the level of corruption. Basically, near every farm in Ethiopia was calling its coffee fair trade when only a tiny handful of them had actually been through the process. And the folks at Fair Trade got tired of asking nicely. So they had been working on and asked us if we could do an IoT-based provenance solution where farmers who actually had been through the fair trade process could purchase from fair trade a set of RFID tags that they could put in their coffee bags. They would only be sold volumes commensurate with the capacity of the farm to reduce the opportunity for black marketeering. And we were working with the client on trying to map this out, and it became clear that once this would solve the problem at the farm, but once it reached the roaster, the grader, the market floor itself, coffees would be mixed, and the ability to track provenance would then be diluted, and could still be easily gamed. So it occurred to me at this point that the blockchain might be an excellent solution for nailing down the provenance and tracking the coffee as it went through all of these various transactions, all the way to somebody sitting at their kitchen table scanning a QR code on their coffee bag and being able to see a Google Earth picture of the farm where it was raised.
Excellent. So thank you very much for that. I mean, the story in Nairobi is fascinating, and it's interesting. Have they actually moved on and explored to using blockchain since then?
Yeah, yes, they have. I think there are several firms, several startups that are actively focused on this exact use case, and are I don't know which of them, if any, have won the business yet, but I know there are a couple startups that are looking specifically at fair trade coffee as the basis for a provenance solution. And then of course, we have other provenance solutions like Everledger, like TradeLens. So this is becoming a relatively common use case in the blockchain space.
So, provenance is one of these, use cases which blockchain is truly a transformational technology. But in what other areas do you believe blockchain, can have a massive impact?
Well, I thank you for giving the opportunity to plug myself, because you may be aware that in August, Anthony Welfare is publishing a book called Commercializing Blockchain. He asked me to write one of the chapters, and the chapter I wrote is addressing this exact question. And in that chapter, what I do is I trace the history of the set of innovations that have been trying to solve the same problem. Blockchain is an innovation that addresses what I refer to as the world's oldest business requirement. And this is a requirement that goes back about 12,000 years. So about 4,000 years before the invention of writing, when we were making the world's very first contracts, or at least the first ones that we know of today. And the way it worked was like this. Let's suppose that you are a farmer in ancient Sumeria, and you own an ox. Therefore, your capacity, the amount of land you can farm, is constrained by how much land this ox can plow in the appropriate time of the year. And that land, that is enough for you to grow crops and feed your family. Imagine you have a brother who also has his family and has a farm of roughly similar size and one ox just next to yours. One day, while taking his produce to market, your brother is set upon by bandits and killed, and his ox is taken. So now you're responsible for feeding your brother's family as well as your own, and you don't have an ox to do it, so you're stuck. So you make a deal with a neighbor who has more oxen than he needs to plow his field. Perhaps that ox has given birth and has a yearling now. And you do the deal that says, if you lend me your ox for 3 weeks to plow my brother's fields, in addition to my own, when harvest time comes, I will give you 10 bushels of grain. So you do the deal, and you plow the fields, and then harvest time comes, and you bring over your 10 bushels of grain, and your neighbor says, wait, I said 12. You said, no, you said 10. Next year, the two of you don't do the deal because you don't trust each other. And your ability to feed your brother's family is now at risk. So this is a problem. So the innovators of that day were equal to the task. And actually, let me step back. It's not a coincidence that this first started happening about 12,000 years ago. This is not something we needed to worry about when we were hunter-gatherers. So this first business requirement is really about the need to model future commitments, which in a nomadic society wasn't that important. So the innovators of that day came up with a solution. And that solution was, in fact, tokens. So this is not a new idea. And being clever innovators, they made the most of the resources they had at hand. And this being ancient Sumeria, the resource that everyone had lots of was mud. So what they did was they took a bunch of mud and they baked it into a hollow ball. And inside the ball, they put a set of tokens that was equivalent to the number of bushels of grain. So you would fire the ball with the other contract holder, and the two of you would have this ball that was held in the hands of the creditor, the person who received the debt. And at the end of the season, you would break open the ball together, count the number of tokens, and you had an independently verifiable, tokenized representation of your contract. This is called a bulla, and if you go to the British Museum, you can see examples of them. And it's the world's oldest contract that we know of. Now, this, of course, changed things a lot, and this was as transformative as the internet of our day, or indeed as of blockchain, because it allowed, for the first time, farmers to have this idea of scale. Okay, so if I can do this for my brother's field, why can't I do this for 20 different oxen? Why can't I now start growing my business, my firm, which in this case is my farm? So people did that. They started contracting and lending out oxen, and other people went into the ox breeding business. So they had lots of oxen to lend out, and people started growing. Until the day when you went into your storehouse, one midsummer's day, and saw a stack of 30 of these bullas sitting on a shelf, and realized that you no longer had any clue how many tokens were in these balls. So this set an upper limit on scale, which was the limit of the human memory to think about how many tokens are in these things. But once again, the innovators of the day were up to the task. What they started doing, and you can see the development of these innovations in the archaeological record. What they started doing was making indentations on the outside of the bulla to represent how many tokens were on the inside. So at least you had a notional view of the contents, and you could go into your storehouse and actually tote up what is your debt or what is your income that's coming at harvest time. This then allowed you to scale even further, to grow your farm or your ox breeding business even higher. And the next innovation or evolution of this technology was complexity. Perhaps you could now make a deal for 10 bushels of grain and 5 bushels of barley. And what they would do is they would start making different tokens on the inside, different shaped pebbles, and different shaped indentations on the outside. So maybe a line would be a token of a bushel of wheat, and a cross would be a bushel of barley. These symbols started getting more and more complex and conveying more and more meaning, until the next great epiphany, or the aha moment, was somebody realized the symbols have really supplanted the tokens themselves. And as long as both parties are there when the symbols are being drawn and can verify that they're accurate, we don't really need the tokens at all. So let's save space, smash this ball down into a sheet so it's easier to store, and you have, in essence, cuneiform script, the oldest form of writing.
Yeah.
So writing actually developed out of the need to model future commitments. And it was a full 1,000 years between the time that writing was first prevalent, when they squished the ball, if you like, and the time that somebody realized that you could use writing for law, politics, religion, literature, music, and everything else we use writing for now. But writing was a direct result of the need to model future commitments, and the need to have an independently verifiable record of that commitment, a ledger, in other words.
Yeah.
So blockchain is and you can trace the further evolution through tally sticks and chirographs, double entry accounting, all the way from then to now, as continuing to find better and better ways of addressing this world's oldest business requirement. And blockchain is just the latest step in this journey, and it's a huge, it's as transformative as the invention of the bulla itself, because it allows you to do this at a hitherto unimagined scale, and you no longer have to keep multiple copies of your contract in sync. When I explain blockchain to complete neophytes in one sentence, I tell them it's Dropbox for ledgers. You write a transaction once, and it automatically gets synced to a bunch of places.
At least a bit more than just Dropbox for ledgers. You've seen, I'm sure a lot of blockchain projects, come and go all around the world. Could you please give us an overview, either of market data, what makes a successful or a failed blockchain project?
Sure. Market data. There have been Statista put this out. There have been 80,000 roughly blockchain projects around the world of various kinds. This includes both startups, enterprise blockchain POCs and pilots, as well as various crypto projects. Of those 80,000 or so, about 92% have already failed. And that's actually, it sounds like a lot, but if you look at overall startup failure rates, that's actually pretty good.
Yeah.
So there's a lot, a lot doing this, and despite being in the trough of disillusionment of the hype curve, which we very much are, the amount of investment in blockchain projects is projected to grow by Gartner by 88% this year. The market is very positive. Measured anecdotally, I can say we do this for a living and are inundated with work.
Yeah.
I met the business development targets for my own tiny firm. As a matter of fact, just a couple of weeks ago, I signed a couple additional deals that booked me solid for the year. So now I'm looking at ways to grow the firm. There's no shortage of work out there. There's a lot to do, and the money is being spent.
See, what's interesting is that we hear, here at Insureblocks, we hear similar, anecdotal stories, from different sources. But then you get McKinsey who builds a report called, Blockchain's All-Time Problem, basically saying that, despite billions of dollars of investment, there is very little demonstrable results from blockchain, and that they expect, effectively spending to drop. But then, as I say, we hear different stories coming left, right, and center, and I just wanted to get your views on that.
Well, I think it depends on what you're measuring. So, what's interesting is that you can actually sort of detect patterns by looking at comparing various statistics. So, for instance, 81%, I think, is the number of the Fortune 2000, the top 2,000 biggest companies in the world, claim that they will have some kind of blockchain solution, at least in pilot, if not production, by the end of 2020. 49% say that they are actively hiring blockchain talent. However, if you survey the CIOs of those same companies, 77% say they have no interest in blockchain. And the thing is, I actually think that they're telling the truth. I don't, those numbers aren't as contradictory as they seem, but they do give a good indication of what's happening. Unlike many other, enabling technologies, what this says is that the push to adopt blockchain is not coming from IT, and that these large enterprises are looking to their IT departments largely to keep the lights on. Given the rise of all of these data breaches, security issues, given the rapid development of new regulations and policies around data protection and compliance, this is not surprising that these are the priorities that are being given to enterprise IT departments. So where's all this blockchain development happening? Well, number one, it's being sponsored by the business, not by IT. It's being delivered by outsiders, which is why my tiny firm, as well as many others like mine, are not having a problem finding work. And most importantly, it's not being done at the enterprise level. Most of these blockchain projects, POCs and pilots, are being done at a line of business level. So if a head of an individual line of business within an enterprise is doing it, it may not show up on the CIO's radar. It may not show up, and if it's being done by outsiders, it may not show up on the enterprise architecture, the enterprise development radar. So the numbers about CIOs not having an interest and the numbers coming out of the McKinsey report are not actually inconsistent with the patterns that we're seeing about where the money is being spent, at what level in the organization, and what's doing. What's also interesting, and it makes sense once you start putting this together, is that it's the line of business leaders that are seeing the benefit from this.
Correct.
And so they're the ones spending the money.
So, have you identified commonalities between what constitutes a successful or a failed blockchain project, and if yes, what are they?
Absolutely. And there are, of course, many of them, but one of them is so preponderant that I'm just going to give you the main one, which is, and it's around adoption. And I cannot tell you how many business cases I've been asked to look at where somebody says, we envision this platform, this ecosystem, and they have new words for it now, but where everybody who participates in this blockchain-enabled trading network derives huge amounts of benefit from using the network. But all of those benefits assume that the network is in place and has reached critical mass. There is, and the mistake is that people just assume through some sort of magic that everybody's willing to sign up to the network because they share this view of how great it's going to be once everybody is on it. But that's not how the world works. TradeLens is finally sort of turning the corner, but for a long time, from when they released, they had this problem because TradeLens was perceived as being owned by Maersk. Even though the data governance in TradeLens is actually pretty decent, and Maersk has a well-engineered product on its hands, because it was perceived as Maersk's data, nobody wanted to use it. And this is exactly the thing. So, this sort of thinking is so prevalent and so terrible, and particularly in the shared ID space, where you've got dozens and dozens of startups all saying, "Yeah, we've engineered this solution where we can have a secure ID that's owned by the person, and no impetus for adoption." So one of the first due diligence rules that I apply when I'm hired to advise both an enterprise or a startup is to say, if your business model does not produce a substantial, and I'm talking return on investment 20% or more, whether that's revenue or cost, a substantial bump for the very first user on the network, stop. Don't spend any money unless you can answer that, unless the very first person who signs up realizes a phenomenal savings or phenomenal bump in revenue, even if nobody else ever signs up to use that. Now, if you're looking at something like insurance or like Everledger with diamonds, you can see that. You can see even the very first person using it is going to get a huge benefit. But unless somebody gets benefit just by signing up, stop there. Okay, your glorious visions of an ecosystem are irrelevant without an impetus for adoption.
Excellent. Thank you very much for that. And I think it makes a lot of sense because it doesn't matter how great the system is built, if you're not going to get any users to use it, it's just not going to function. So what kind of anecdotal and or evidence-based discussions have you come across on why requests for blockchain projects funding have succeeded or failed? And here, we can look at it from many different angles, but if you could perhaps give it a go.
Yeah, no, this is actually, again, highly relevant because I'm teaching a course on this in August. So there's a lot of writing out there. What makes a good candidate for a blockchain project versus a bad one? And in fact, we were just talking about one of the key criteria, which is that there has to be value for the first adopter. It has to be a solution where people are actually sharing the ownership of data. A great anti-pattern for this, actually I could think of a couple. So if you look at somebody who has a complete lock on their supply chain, somebody like Tesco. I took part in a study that just got published a couple of weeks ago by Walid of London, which was an analysis of systemic risk for the world food supply chain. And one of the most fascinating things that I learned was that big food retailers like Tesco have become the de facto regulators. and that their regulations are both more strict and more enforced than government regulations around food safety. And the reason is in the numbers. So if you run a farm, a chicken farm, and you have a health violation, one of your chickens has salmonella or something like that, and the government finds out, they'll fine you 30,000 pounds or whatever it is. Tesco finds out you're out of business. You're done. So Tesco has much more clout when enforcing food safety. I cite that as a way of saying that Tesco has a complete lock on the supply chain. Therefore, it does not need and would waste money if it ever invested in blockchain. Okay, it doesn't need it. It can basically force its suppliers, give me your data, and put that data in a database which they own. So that there's no benefit to them to having this decentralized data model. They can mandate a centralized one, which they have full control over. So why would they ever use blockchain? Another great anti-pattern, this happened, I think, early in 2018. I saw that Singapore Airlines had announced that they were going to put all of their customer loyalty data on blockchain. Okay, so on the surface of it, you say, okay, well, loyal frequent flyer programs have many partners where you can earn and spend your air miles. But when you start to scratch the surface, you say, wait a second. Does that mean that Singapore Airlines is going to fully share ownership of those air miles, or ever agree to a consensus model where another party can challenge or in fact deny consensus on committing an air mile transaction? Of course, they are never going to share ownership of their treasure trove of customer loyalty data. They'll share the use of it, they'll share the utility from it, but they're not going to share the ownership or the right to determine what's a valid transaction. So another case where you hear blockchain discussed in this context and you say, why?
So how important is knowing the true cost of running an existing processes? Because the thing is, especially as you may know in insurance, if you want to build a business case for launching a blockchain project and you're trying to say, we're going to improve your process by X, that means that you have a clear understanding of what is the cost of running the existing process, right? And most insurers have no clue. They say, yeah, it'll take X amount of emails, X amount of phone calls. What do I do? Do I measure the time it takes me to write that email by my salary? How do you go around building a blockchain project and say, I'm going to improve your process by X amount when you don't even know the cost of running it?
And this is actually exactly what the class is about, is teaching these techniques. And a lot of what we're going to be teaching are things that we learned in the process of creating the business model for DLT-based trade settlement and claims agreement for Lloyd's as part of the LM Tom program. So before we got the chance to build a DLT prototype, we worked on a feasibility study. So we were asked two basic questions. One is it possible to conceive of a business model for running both Lloyd's and company market business without the need for a central transaction processing capability, in other words, a bureau? And if so, what would the economic case for doing that be? So we did a feasibility study, and there were three of us. There were Charles Elrinde from AXA, Richard Borum from ChainNat, and myself were tasked with this exact problem. And the first thing that we had to do was to quantify what the benefits were, to address the exact question that you just asked, which is, how do you measure what the cost savings are? And the reason that a lot of people struggle with this, and the reason we're going to teach a class on it, is because the techniques for doing this, and they do exist, are old and profoundly uncool. they're not rocket science, but they are part of a body of practice that used to be called operations research, and they really were these techniques were in their heyday in the late 1960s and early 1970s, and they were at the time mandatory and the hot topic when you went to business school. I went to business school in the late 80s. And everything was about mergers and acquisitions, leveraged buyouts, and so forth. But this was the trend before then. By the time I got to business school, operations research was an elective course, and further down the line, in most business schools, it's just not taught anymore. But this is a discipline that where people know how to measure these things, because if you wanted to drive cost or gain efficiency out of your operation when almost all business processes were manual, you needed to be very good at measuring the cost of manual processes. So they were. But because more and more processes are being automated and because we're pushing it, the discipline of how to measure this has largely atrophied. But it still exists, and we used it. And we used it to develop the business case for Lloyd's. And I would say in a career of over 30 years doing technology-enabled business transformation of one kind or another, I have never in my career seen a business case remotely as compelling as the Lloyd's business case for automating using DLT. It was astounding. And the techniques exist, and they're not rocket science.
And what, in your opinion, was the business case so strong?
Because it is absolutely centered around the core, what I believe is the core value proposition of blockchain, which is this world's oldest business requirement. Lloyd's spends many, and it's not just Lloyd's, it's the company market as well. It spends many times more money, time, and effort keeping the various partners and signatories to an insurance contract in sync than they do on primary value creation. The expense ratio of Lloyd's is much higher than any place else in the world, and they're using a set of business processes that may have been automated in the 80s, but the processes themselves, derive from the fact that Lloyd's is the world's first financial market. Even if you go onto the trading floor at Lloyd's, and in fact, there is still a physical trading floor, unlike many financial markets, you can see that the boxes, as they're called, you can easily see that their history lies in booths in a coffee shop, which is in fact, we know how Lloyd's got started. The business processes for settling and for claims agreement were really first codified in 1810, and many of them haven't changed much since then. So the idea of a solution that eliminates the need for a central transaction processing capability is huge. But even outside of Lloyd's or placement of syndicated risk, you're seeing tremendous changes. Blocksure is doing some work, and is in production, sourcing insurance here in the UK, and it's seeing similar order of magnitude cost reductions in its operating costs for new lines of business compared to what it would cost to launch those lines of business with a traditional process. So it's not just Lloyd's, and in fact, this same operational transformation is what makes it possible to do some business models that have never been done before. One of our active projects at FinServ Experts is delivering microinsurance for natural disasters in Indonesia. This is a product that is desperately needed. Only 6% of Indonesians currently have access to any kind of insurance because the cost of placing it compared to the amount of coverage just makes it it makes it unaffordable, but even worse than that, it makes it regressive. So what that means is, a carrier is looking at this and saying, if I offer this insurance, what I, in essence, have to do is charge the highest premiums for the people who can afford it the least. And most people don't want to run regressive business models. They don't like the idea that they're gouging the poor. But there's no other way to do it. So blockchain completely changes that calculus. And it's not just blockchain. It's if you pay a claim, in many places in Indonesia, the only way to pay the claim right now, and this is not an exaggeration, is to send somebody out to a village in a helicopter with a suitcase of cash. Well, again, if you're talking about small amounts, the cost of the helicopter flight is worth more than the cost of the claim. It's not just blockchain, but it's the idea that you can now pay directly into a mobile wallet. Because if you survive a natural disaster at all, the one thing that will be sure is that you've got your phone in your hands. So it's an elegant and effective way of actually paying out the claims, as well as managing the operational costs of doing the placement. So so it's, like I said, coming back full circle, it's not just Lloyd's, although Lloyd's is a textbook case. It's the insurance value proposition in general that stands to be revolutionized.
So having a clear business case, understanding the cost of your business, how important would you say is also having the relevant business partners and the ability to start small, taking effectively a startup approach?
First of all, it's imperative. If you don't have your business partners around the table, don't start. Blockchain is a multi-party solution. And if you're trying to develop a solution without the other members of your Envision trading network, you're doing something wrong. So it's, there aren't too many binaries in the world, but this is one of them. If you don't have your business partners involved, don't even start. Starting small, I don't necessarily think it's a question of size, but a question of focus. And the advice I would give, and this is not just to insurance, but to any, is to start your blockchain journey with new lines of business, new products, or new customer segments. Okay, this is where you should see the first changes, and the reason is very basic, because neither you nor the other members of your trading network have to worry about transformation costs. If you take a look at core banking in Africa, the newer core banking products are cheaper, better, run faster, better architected, more secure. And most of the banks in Africa can't access these products not because they can't afford them, but because of the cost of transformation can often be tens of millions of dollars, more than these banks' entire asset holdings. So they are permanently bolted into a more expensive, hard to own, insecure, less efficient solution, not because of the cost of the new products, but because of the cost of transformation. If you start with a new line of business or addressing a new customer segment or offering a new product, you don't have to worry about those transformation costs. So it's less a question of size and more a question of focus.
So what kind of framework of thinking have you developed to request investment in a blockchain project? And that can be both, of course, applicable to a startup or within an enterprise.
Well, I think your question actually highlights a key point, which is that it's the same. If you're trying to get investment, it's convincing a group of people that there is derived value in what you're doing. And in the case of a founder, you are convincing a group of venture capitalists, angel investors, or indeed the general public if you're going down the ICO, STO route. If you're in charge of innovation in an enterprise, you're convincing an executive committee or a board. But it's the same conversation fundamentally. And the framework of thinking has to be present the benefits in a way that somebody understands. So if you're talking about insurance, somebody says, well, this allows us to address an entirely new segment of customers. This allows us to bring a new product to market. And everybody's going around and say, yeah, I get that. And I'm assuming as a starting point that you have a good blockchain project that meets all the criteria we've already discussed. And then so some investors and board members are usually fairly intelligent, so they're nodding their heads and they're saying, okay, yeah, I get this. This makes sense. It's a good use case for blockchain. What quantitative benefits are you going to be able to commit to? And this is where most, and I do think it's most, people who have brilliant blockchain ideas fall short. They don't have this framework of thinking about how to quantify the benefits. It's not rocket science. It's rocket science. There's a lot of footwork involved, but the techniques aren't taught anymore. So people don't have the training to think about business processes, in particular manual processes, in this way. And it is, the way you described it is an oversimplification, but it's essentially correct, saying, okay, these people are spending this much part of their day doing this reconciliation task. This is their fully loaded cost. Extrapolate, measure the market, and there you go. So it is really exactly the way you described it. Obviously, there's some tools for thinking about it and structuring it, but it's that is at the heart of it. So it's time and motion studies, it's queuing theory, it's Monte Carlo to simulate distribution skews. It's a set of techniques that most of us know, but don't know how to apply in a structured way.
Great. So can you give us an example, a walkthrough, or how can you apply this framework for within the insurance industry?
Sure. Well, I'll tell you how we did it at Lloyd's. One of the biggest drivers of additional cost in processing an insurance contract, or indeed in some cases in agreeing a claim, is the cost of a query, a question where somebody has to ask somebody else before making a decision, because that brings the entire process to a halt. Queries happen because a lot of data isn't kept in sync. So it's very easy to look at a case where, if certain processing is done straight through and there's a shared agreement up front on what the contract is, those certain classes of queries are going to go away entirely. So it's one of the easier things to measure. So what you can do, and what in fact we did, is we looked at a cross-section of firms, some very large, some very small, and said, how much time do they spend handling queries? What percentage of transactions have queries? How many full-time employees spend their time processing queries? And that gives us a basis which we can extrapolate. Now, you can't use just sort of a simple summation and saying, well, these firms said this, and that's this much part of the market, because the fluctuation is, of course, is going to be much higher than that. So it's not quite that simple. We actually ran a Monte Carlo simulation based on the data we'd received, because there was no clear distribution or skew point that we could use to model it effectively. So we ran a simulation based on the answers we were given, and used that as the way of estimating the cost of reduction in one of our process steps. For other process steps, we would use different techniques, but that's one example.
So let's go with another example. So let's see how can you apply this framework for a financial inclusion use case. You mentioned your Indonesian example that could involve numerous partners, and where the value comes from being able to reach an entirely new customer segment that could not have otherwise been serviced in a cost-effective way.
Yeah, so that's a great example. You have the same drastic reduction in operating costs, but since it's net new, you can't model that against anything. You can't say, I'm going to save you 90% of your operating costs, because save 90% of something that doesn't exist isn't very meaningful. So you have to base the business case on revenue drivers. And in this case, the client that we're working for and supporting this project, which is an insurance company, did that the smart way, in that they've been for 2 years running a pilot, and the pilot is offering the product without the platform. So it is a pure zero technology pilot. They are running this for about 60,000 insureds, and have been for 2 years now, with spreadsheets. Working directly with the local insurance companies, agents, cooperatives, co-ops, credit unions, and so forth, and have been placing product, insuring people, handling claims, and now they have 2 years of data to validate the demand. So it's a trap many of us who are deal with technology for our entire careers fall into. Technology is not the driver; the business is. So it was relatively straightforward to offer a product and see what kind of reception and which channels were the best for delivering it, how to engage with people. And as long as you're doing it with a small enough scale, you can still do it on spreadsheets. It's not very efficient. It's risky. It's insecure. I mean, you certainly wouldn't want to run a business this way. But if you're gathering data and you're validating demand, you don't have to wait for the platform to exist. JFDI.
Excellent. So you mentioned earlier on this podcast that you're running a workshop on the very topic that we discussed throughout in Las Vegas on the 19th of August. Can you tell us a little bit more about it?
Sure. The workshop is called Unlocking Investment in Blockchain Projects, and it's a 3-hour course that talks specifically about introducing this framework of thinking for how to present the business benefits of your blockchain project in a way that investors can consume. None of the techniques that we're going to teach are new or are proprietary. They're things you could find by rooting around yourself, but we've done it successfully a few times now. So we're happy to share the benefit of our expertise. The project will be the course will be structured so that we're giving a lecture to explain how we're doing it, and then we'll have a series of group exercises where people will get a little bit of practice applying this thinking to a set of cases, and then present those cases so that people can learn not only from ourselves but from one another.
And who is it aimed at? Is it for anyone who can go there, or?
It's aimed at people who have an idea for the blockchain project. Could be a startup, could be enterprise, but don't know how or haven't been successful presenting their business case to people and saying, yes, okay, we'll spend some money to do this. Great.
And we're going to put a link on our webpage for anyone who wants to find out more about this workshop and also if they wish to book a place in there. So thank you very much, Areiel, for all your great insights on how to unlock investment in the blockchain project. I'm afraid we're out of time. So this wraps up this Insureblocks podcast. We hope you've enjoyed this episode. If you like what you've heard this week, don't forget to subscribe to our podcast and leave us a review on iTunes. Areiel, we're going to wish you the best of luck at the workshop, and we look forward to catching up with you. Thanks very much. It's been great talking to you.